Good time to get some perspective in on this market. We've got our next guest joining in, George Joseph, CIO and CEO Equity at ASK Investment Managers is with us. George, morning. Great to have you back on the program. How have you been?
Thank you, and thank you for having me here, and also very, very good situation to be in.
So, George, I think, the one thing that everybody is celebrating is the fact that earnings season has not been a washout. A lot of companies have shown resilience. Let's start right there. Just call out some of the clear trends that you observed. Walk us through your portfolio stocks. Where do you see the likelihood of strong earnings continuing? And what was your takeaway? Maybe management commentary, anything that really stood out for you in this season?
So we can't complain. The results season, it has been great. If you see the number of beats in Nifty as well as in beyond Nifty also is quite exciting compared to what people were expecting. So the street expectations were mixed bag, but what I can see is that Nifty companies as well as the non-Nifty companies have beaten the expectation in many cases. And it is more number of beats than the disappointments. So that is the summary. But when I look at in detail, what I clearly see is that some of the trends which we have been betting on. One is, the financialization of the economy is clearly taking shape, and that is leading to a lot of tailwinds for many companies. Second is the digitalization, and that is again has a good trend developing, and many companies which are into adopting it faster, be it digital penetration stories. That is one broad theme. Manufacturing, if you see across board, be it auto sector or otherwise, be it chemicals and beyond, all of them are very exciting. Most of the chemical companies, especially food and chemistry based chemical companies, have reported very good numbers. Textiles, again, some of the numbers which has come up, be it spinners or cotton yarn manufacturers. So if you see, there is a good amount of earnings beat there as well. So, we have been very, very constructive, picking up some of the bottom-up names for our clients' portfolios.
Okay. I just want to start with the financials, George. What has your read-through been in terms of, because even the banking sector was showing a lot of different trends. Different lenders had a different path. So what kind of stocks would you back right now? And then there is this whole NBFC debate. I mean, with the RBI looking at new regulation to curb revolving credit, in a matter of 2-3 days, we've seen, 7-8% gone from large stocks. So how are you looking at both the pieces, lending, banks and NBFCs, and what are you willing to add to the portfolio now?
Yeah, so most of the NBFCs, the large NBFCs, if you look at last 5-year returns, is more or less zero. And also the large private banks, the returns are almost abysmally zero, even though companies have been making profits and also gaining market share, and even be it deposit market share as well as loan book market share. If you see, these companies have been gaining, but market has not rewarded. If you see, the banking sector per se has benefited last 5 years to 6 years. When I look back, when the gross NPA in the system was for PSU banks were more about 11.5%. Now it has come down significantly. So last 5 to 6 years, predominantly was a recovery game. The sectors which recovered are metals, commodities in general, and real estate. All the sectors which were in trouble in the last decade, they were the ones recovered, because of which the recovery and the payback to the banks have happened from the corporates in a material fashion, and that's why the NPAs have come off. For last 5 to 6 years, more of a recovery game. I think going forward, it will be more of a credit growth game, and that's where the large private banks looking very interesting to me, because they have been very resilient in terms of underwriting capability and how they have displayed in the past, and also their deposit market share and loan book market share is growing. So which is which is very interesting scenario. I don't deny that some of the large private PSU banks are also in a very interesting situation. So going forward, who actually captures the good credit growth market will be the play. And we have seen the last 3 months consistently, the credit growth numbers have been inching up, and that will be the scenario. Having said that, the risk is associated with the global uncertainties which is prevailing, be it geopolitics, be it trade policies, global trade policies, or interest rate scenario where US yields are spiking. So some of the risk off elements can kick in, and also the uncertainty around the entire oil price. So all of them are negative from the near-term perspective, but India's structural story remains intact. When I look at the numbers, when I look at some of the names, be it in large cap space, we have been significantly skewed towards the large cap space because the valuation looks extremely attractive to us after 5 years of non-performance. And you have to pick and choose the bottom-up names in mid and small cap or micro caps, depending upon the sector tailwinds what you're seeing, be it textile, chemicals, as I mentioned earlier.
Okay. So large private banks as well as large PSU banks got that. Now, but what about NBFCs, George? What are you,
Yeah, so NBFCs,
buying and what are you avoiding
yeah.
there?
So NBFCs, large NBFCs, they have a proven track record of creating a fantastic, niche business model compared to banks. And those companies also have been going through the similar phase where the credit growth in the system was slow. They were very careful about lending, and therefore, the market has not rewarded in terms of valuation, and valuation derating was happening for large NBFCs. I think that phase is over. Incrementally, we will see these companies doing well, but the revolving credit with the news which came in recently, which is potentially a concern for a near term. But these companies are capable of handling different kinds of market situations where RBI has intervened, and so on and so forth. So I presume that is only a short-term negative situation, but these all will bounce back. Ultimately, the credit growth and the growth which these guys can offer over a period of next 5-10 years is phenomenal. And the credit penetration in the country is very low. So there is a huge runway for these companies even today.
So basically, you're saying credit growth is the big story. I mean, that's the big one in the room right now, and therefore you will
That's
back
right.
large banks and large NBFCs.
And also the large
Got that,
NBFCs
George.
as well.
Got it. So what else? I remember when we spoke, sometime back, couple of weeks back, you were telling us that you like to play the data center story through power equipment companies that are manufacturing equipment, or basically the power suppliers, because that's a big requirement for data centers. Just walk us a little more through that thesis, and how are you playing that chain? What did you think of a lot of these power equipment companies as they reported numbers? Some of the stocks did really well. I mean, how do you find valuations, growth, and just how you're thinking about this whole, play data centers through power as a theme?
Yeah, so specifically to that, AI in general, which is, I think, it's a fully blown out of proportion in terms of as a theme globally. But in India, if you look at the data center capex plays and indirect plays, which will support power transmission or power equipment, be it suppliers to electrification of the data center capex. If you look at those companies, are looking very interesting. Some of the MNC names in that pack, we are owning it and we quite like it from a long-term return perspective. And if you see generally, the growth in the sector is also the capex story in India has already started. The top 500 companies in the market in India, if you look at the corporates which are listed, most of them, the capex is growing by 20% CAGR plus, and which is very interesting. And that's when not only the data centers related, but general capex also is kicking in, and that we are seeing in most of the companies' order book pickup as well. So there is a good play on capex which we can think about for manufacturing capex. energy transition and, data center related capex also, which is very, very prominent globally as well as in India, which is looking very interesting to us. There are very interesting names, as you rightly mentioned, the order book growth as well as the earnings beat in some of these companies have been phenomenal. So as a house, we are betting on cyclicals, the sectors which are cyclically bound to benefit, be it commodities to a certain extent, even though we are not big fan about commodities. We know that when inflation is higher, commodities generally do well. So we are mindful about that. From commodity, proxies we look at, engineering, capital goods sector, banking and financial services sector, real estate, and also when we look at some of the chemicals and the manufacturing related plays. Textiles is another one which is looking interesting to me from the FTAs, and when you look at
So,
the ecosystem is getting built.
So, George, again, just to understand this clearly, again, the big play here is capex growing at 20% in India, which is, which is a big trend, big number we can't ignore after a long time. So, you would play that through what order? What would be the order in which the segments or the sectors through which you'll play this big capex theme?
So, capital goods sector is one direct place, which is suppliers to the capex story. The construction related plays are interesting. The one who is funding all these is a critical play, which we discussed about, large banks and some of
Financials.
the
Yeah.
NBFCs, which will be benefits out of it. And then, when you look at some of the beneficiaries of, if somebody has put up a huge capex, eventually it will show up in their operating leverage and, revenue growth, and then they get the multiples as well. So the phase, what we are seeing since 2020 is a very high capex related place. Initially, 4 5 years more of a recovery phase, even though it's a semi capex phase where companies were putting up capex with internal accruals and also paying to the banks. Now it is a phase where the clear funded capex related stories will start kicking in, and that's where we see lot many opportunities, across board.
So, George, does that mean, since and I understand your view on capex very well, but does that mean that you're not looking at putting too much money to work on the consumption side of things? How are you looking at the whole consumption basket? And it's a huge basket now, from from autos to jewelry on the discretionary side to FMCG companies. A lot of staple companies reported better numbers than what we've seen in the last 1 2 years.
Absolutely right. So those companies, the way we look at is at this point in time, so we call it as defensive basket and cyclical basket. So cyclical basket, as we explained, even the IT sector comes in the global cyclical basket, which also is becoming interesting. The defensive basket, you need to have some place there because, portfolio will be, more defensive to any big economic shocks, because these companies have been very resilient in their earnings profile as well as the growth profile. But last 5 6 years, these companies have not generated any returns because the obscene valuation in 2020 and then going through a rating phase, and also the earnings were not coming through. But some discretionary plays and consumption is some we are interested to look at. So, proxy to consumption, we can say electronic manufacturing companies, or when you look at paint companies, after a big lull period in the last 4 5 years with the competition and all kicking in, some of the paint companies are becoming interesting. So we are looking at a discretionary place, not like staples, because staples, because of the discretionary spending increasing, you are not going to consume more of staples, and therefore, even though the earnings beat might be there, but it is already capturing in a lot of in the valuation as well.
Understood, understood. So EMS and paints, some sort of corollaries through which you are
And also
playing
consumer
rising
services
discretionary
businesses as well.
consumption.
And consumer services
What
as
do you
well.
mean by
That is
consumer
also.
services?
So consumer services is all the food tech companies and the entire basket which is serving consumers through various modes, right?
So that would be a lot of the internet players, right? I mean, it's kind of internet slash platform driven consumption. Is that what you're referring to?
Yeah, platform-driven consumption. And if you, yeah, that's right. And also, if you look at the auto sector as well, right? So auto, we have a good exposure in most of the portfolios, significantly overweight. And the reason behind is that, that is a proxy manufacturing play, export-oriented manufacturing play, as well as there is a complete change in the way the EV theme is picking up. So companies which are tuned to the EV theme as well as managing their existing portfolio well, those are the companies which will do well. And so that proxy domestic consumption and export story, we call it, and that is looking interesting.
Got
So
it.
that is also part of our
George, you
consumption
mentioned,
basket.
got it. So autos as well. There was a passing mention on IT there. You said that it started looking interesting. Would you expand on that?
Yeah, so
And IT's become more of a tactical trade, right, than anything else. And you have phases in which these stocks nicely rally and give you 20% on the portfolio. So I mean, how are you looking at IT right now? Which part of it is it
so
tactical? Is it strategic?
So if you look at we tend to call it as tactical at this point in time because a lot of unknowns are there. How the entire AI landscape will function, and what is the kind of impact these companies will have. A lot of unknowns. But if you see the key problem with the IT sector was the valuations were very steep and the growth was very slow, right? And that was the biggest challenge this sector was facing. I think personally, the sector is coming out of that problem because there is a significant AI transformation led projects will kick in. And the next 4 or 5 years, these companies will get huge orders on that basket. And that becomes a good growth engine for these companies, which were not there earlier. Having said that, a lot of coding jobs and all are going out of these companies, which creates earnings pressure and margin pressure on the other side, the existing business. But the growth engine somehow is shifting towards positive, and which is where these companies at the dirt cheap valuation, what it is trading today, may warrant a fresh look and see that whether it makes sense to own it from the next. And alongside, you're seeing the global uncertainties of INR depreciation and so on and so forth. So in that context, it becomes a good anti-AI play globally for an FII when they look at it. Secondly, from Indian context, it becomes a good hedge in your portfolio also.
Yeah. Okay. So good hedge, a good tactical play. And we've seen that. We've seen some accumulation at the lows. We've seen some signs of life. The stocks have stopped falling, and I think that itself tells us a story. George, finally then, I mean, good conversation. We've really, gone into a lot of granular sectoral details. But what's the big picture? Next, say, 6 odd months for this market, at an index level, will it still be range bound? Or do you expect a big breakout?
So I think this, if you look at the small cap index has already broken out and mid cap index has broken out from their long-term average, and only the Nifty 50 has not broken out. So our bet is that there is a significant room for Nifty-based companies or the large cap companies to come back strongly. Mainly because of the reason that FIs have very less opportunities now after Kospi and Taiwan themselves in terms of the stock prices are falling, the index is falling heavily. Those semiconductor and AI plays are waning out. So there is a good case India weightages in the emerging market index will go up. Therefore, the flows can kick in, and the FCNRB measures by RBI and that also will put some controls on the INR depreciation element. So having all these coming together, there is a good chance that FI money coming back and which can attract large caps in general. If you see last 3 years, consistently the flow of money was mainly domestic, which was going into mid and small cap. So the mid and small cap segment has become extremely overvalued because of the mutual fund money flowing in there. But the opportunity I see very clearly, having many stocks not doing anything great for the last 5 years in the Nifty 50 basket, and plus the of money kicking in, that basket can outperform over the next few quarters. Generally, we don't take a quarterly call. We look at bit long term. We look at good quality compounders which can compound for the next 5 years, 10 years. That is the way we think about it. But market forces us to think sometimes, these anomalies kicking in and becomes an opportunity.
Okay. All right, George, we'll leave it on that note. Good conversation as always. Thanks very much for explaining to us how you are thinking about the portfolio, the market, and where the positioning is right now. Appreciate you being with us.
Thank you very much.
Have a good one, and we'll connect again soon. Thank you.
Sure.
Okay, well, on that note, let's quickly